Let's take a look at the statement of cash flows. This formal statement, as required by the IOFA Financial Accounting Standards, must show the cash flows from operating activities. It must also show the cash flow from investing activities and the cash flow from financing activities. What we are presenting here is the statement of cash flows using the indirect method, where it starts from the net profit or loss for the year insofar as presenting the cash flows from operating activities. Then the adjustments for this normally refers to the non-cash items. For example, the net impairment loss on financing assets, the impairment loss on investment securities, the depreciation and amortization, and other non-cash items. Then we need to present also the changes in operating assets and liabilities, the profit or loss, before changes in operating assets and liabilities, like the change in reserve account with central banks, change in due from banks, change in financing assets, and others. Usually, certified public accountants and accounting practitioners are really acquainted with the rules in preparing the statement of cash flows using the indirect method. So that is the first one, the presentation of cash flows from operating activities. Then we have also the cash flows from investing activities, which actually shows the actual cash movement. Like, for example, the cash acquisition of investment securities, the cash proceeds from sale of investment securities, the cash acquisition of fixed assets, and etc. Also, the cash flows from financing activities, which also shows the actual cash movement insofar as financing activities are concerned. For example, the change in investment accounts, the cash change, or the cash inflow or cash outflow as a result of change in investment accounts, the cash proceeds from issuance of share capital, the cash proceeds from financing liabilities. And until we arrive at the net increase or decrease in cash and cash equivalents, this refers to the net cash provided or used when combining these activities, like the operating activities, the investing activities, and the financing activities. Then after that, we must add the cash and cash equivalents at the beginning of the year. And of course, the effects of exchange rate changes on cash and cash equivalents held, until we arrive at the cash and cash equivalents at the end of the year, which must reconcile with the cash and cash equivalents as presented under the balance sheet.